cumulative banks that have failed, if you look at each year, it's gotten worse. 2008, 2009, 2010. The verdict is out for 2011. But the issue is simply this: is the worst behind us or yet to come? We have a situation where the banks are getting to play an Enron game with bad bets and just pretend that they don't even exist. While we talk about there being recovery, while we talk about the financial system recovering and banks, you know, sort of getting back to normal, it's anything but normal, and you can see that with the cumulative bank failures, it's actually getting worse at the margins. We talked about the three different kinds of fiscal pressure at the federal level, at the state municipal level, at the level of households. This is balance sheet weakness, which requires a certain kind of insurance, and that's where individuals and institutions and even central banks are moving to the protection of gold as a way to hedge out balance sheet instability. Inflation is a global reality, and it has to be reckoned with by individuals and institutions alike. Inflation is a reality because monetary madness is the only choice we have. Our monetary mandarins, all that they can do to create that sense of normalcy again is to print and print and print.
Inflation is our friend. For example, consider this. In the year 2000, if current trends continue, the average blue-collar annual wage in this country will be $568,000.
Inflation is the loss of purchasing power as a result of too much money being printed. It thus takes that many more currency units or dollars to buy the same things. Inflation is something that is a real-world reality. It's something that is upsetting geopolitical relationships. It's something that is upsetting political dynasties throughout the Middle East. Inflation is something that is a force to be reckoned with.
Have you heard of the velocity of money?
No. What is the velocity of money?
The velocity of money is the number of times a dollar travels through an economy.
What do you mean? A dollar travels through an economy?
Each time a dollar is taken from the bank and is borrowed or spent and redeposited at the bank.
So each dollar travels through the economy only one time then?
No. That $1 may circle back around and in, and out, and in and out, and in, and out, and in and out, and in and out, and in and out, and in and out, and in, and out, and in and out, and in and out of the banking system. So that $1 at the end of the year may have had a $50 footprint as it is multiplied through the market.
That's great. So the velocity is extremely high then?
No, not right now. Since interest rates are so low, banks make more money investing in treasuries. So there is no incentive for them to lend money to anyone. Therefore, velocity is broken.
Ouch. That hurts me. Really hurts, Abe.
I hope you don't need a loan. The trillions of dollars created out of thin air by the Fed will be multiplied when velocity picks up again.
Why? Is that a problem?
That is a huge problem. It's called hyperinflation.
Is that a new monetary standard?
Yeah, it's the penny standard.
The Fed has created several $1 trillion in liquidity. Those trillions, if they make their way into the economy and are multiplied 4 or 5 or 10 times, end up having not a $2 to $3 trillion impact in the market, but having a 10 to 15 to 20 trillion dollar impact in the market. We can go from having very tame inflation, 2 to 4%, to having 5, 6, 8, 12, 20% inflation overnight if velocity increases and the Fed is unwilling to restrict liquidity and actually limit it.
One fear was that inflation could spiral into hyperinflation, as it had in Argentina when the government kept printing more and more currency. At one point, Argentina's inflation got so out of control that consumers rioted against rising prices.
Take the time to read a book by Adam Ferguson called When Money Dies. When Money Dies is an explanation of inflation, but not in economic terms, in social and cultural terms. What happens to a community when you deal with super or even hyperinflation? Right now, velocity is broken. It's not making its way through. And a part of the reason it's not making its way through comes back to the central bank problem, which is if you keep rates too low, then banks don't have an incentive to lend. And here's how that works. If I have to pay you, the depositor, 1/4%, I then take your money and I invest it. I invest it in something that pays me 3%. But better than that, they're able to use leverage. As if you were margining your stock account, they're leveraging your deposits. And what they're doing is they're leveraging it 3 to 4 times at a minimum. Some banks as many as 10 or 12 times. If you're Bear Stearns or Lehman Brothers, it's 40 times. If you're the Federal Reserve Bank of New York, you're leveraged 71 to 1. There's a lot of leverage in the system. But again, this is the issue, that there's no one lending today because they don't need to. And by investing in U.S. Treasuries, I assume that my default risk is 0. Why would a bank lend to you, the small business owner, when I can make 12 to 15% risk-free? By distorting interest rates and pushing them too low, you create this kind of disparity. In fact, in every banking crisis we've ever seen, rates drop, and guess where that cash flow goes? Instead of to you, the depositor, guess where it goes? It goes to the bank to rebuild the balance sheet. So in essence, the banker gets to make the mistake, and you get to pay the price.